Bridge lending, and this is really what I wanted to focus on. Bridge lending is a wonderful tool. Bridge loans, they encompass a large type of loan, let's say. Not all bridge loans are hard money loans. And I'm sure you're all familiar with, everybody talks about hard money loans, everybody talks about higher rates, higher fees, and so forth. But there are some very low rate, very attractive bridge loans that are just short term in nature. Now, typically, a bridge loan is categorized by a loan that is less than 2 years. Usually you're going to have 1 to 2 extension options with that, say 6-month extensions. So 36 months or less would be considered a bridge loan. The leverage on these loans can range anywhere from 55% all the way up to some programs offer 85, maybe even 90%. And there's certain lenders out there that get very, very creative. And we'll talk about this a little bit later too. They get very creative when it comes to how they value the property and what they base their loan on. You're going to see, we talk about it later, you're going to see loan to value, and you're also going to see loan to cost. And it's really important to note those two, but you don't have to write that down now because we will get into it later. The interest rates that you see on bridge loans, they can range. Some firms are out there putting money out at 5%. Other firms, based on their minimum yield, they're putting money out at 16%. I know that raises some brows when you hear 16%, but remember, there's a reason why you're willing to take on those additional expenses. And we'll talk about that because now we're getting into hard money loans. The point structure that you're going to see, anywhere from 1%. Again, some lenders are going all the way up to 6%. As I stated, there has got to be the value when you're taking on a debt load like that. Who's putting this money out? What types of bridge lenders are there? You've got insurance companies. Fannie Mae lenders have a bridge program that they're putting out. It's not a Fannie Mae program, but Fannie Mae lenders are starting to structure their own bridge programs to bring you in and start developing relationships with you. I work with some finance companies that have private client groups made up of high net worth individuals that are looking to hedge their portfolios. And they're lending money out. Those types of loans are typically not high rate. They're typically not speculative. These finance companies really look to protect their client base. They really look to protect their clients' assets, so their due diligence is very high, but the rates are very low. You could work with a private client group and take down a bridge loan at 3 3/4, 4%, because they kind of make it up as they go. They look at the value of the property, they look at the value of the borrower, and they make their decision based on that and present it to their client and see what he's willing to give. So private client groups, they can be hit or miss. Typically it's 10 million and up. They're usually not getting involved below that. Your mainstream bridge lenders are going to be your hedge funds, your investment groups, people that are raising money to put debt out into the market. Some of you may raise money for equity, whether it's 506 or whatever type of raise you're doing, you might raise capital for that. There's a lot of people that are raising money for the other part of the capital stack, the debt side. The difference being they're just looking for that income stream, similar to a bond versus a stock. Your stocks are on your equity side, and your bond market is on the debt side. So there's money being raised for that market as well, and that's where your hedge funds come in, and that's where your various investment groups come in. So that's who's putting the bridge money out on the street. You would use a bridge loan when you need to capitalize on value in the marketplace. When you can see value somewhere, whether you need to act fast, whether you need to, a property's not stabilized, it's underperforming based on the market. These are the times when you would actually use when you can realize the value of paying a little bit more for a property. Stabilization, it's going to vary depending on your market, obviously, but your perm lenders kind of have a staple of what they look for. They look for a property, and this is specific to multifamily now, they look for a property to be between 85% and 90% physically occupied, warm bodies in the units. That's the first part of it. That's considered physical occupancy. And forgive me because I don't know what you folks have talked about earlier. You did talk about physical occupancy? Okay, great. Warm bodies in the units. That's crucial. 85, 90% for about 3 months. That's really what they look for as a bare minimum. Now, one of the things I always say when you're presenting to a lender and you're talking to a lender, it's the equivalent of an employee or a potential employee walking into your office. How many business owners do we have in the room first? You own your own business, you manage employees, you do the hiring, you do the firing. If an individual walked into your office looking very polished, very confident, very excited, and sat down and said, what is the minimum amount of work I have to do to get the highest paycheck from you at the end of the week? You would show them the door. Well, that's the last thing you ever want to say to a lender, is what are your minimum requirements? Because it sets the same tone. If you're looking for properties that just hit the minimum requirements of a lender, in this market, it's not going to happen. I can tell you right now the deal won't go. Because it's too many exceptions and too much work for that loan officer that you're talking to. You've got to set your standards, and this is one of the reasons why Sue is successful, is because her standards for her properties are above the mainstream lender's standards. When she goes in and she sits down and talks to a banker, or she talks to a loan officer somewhere, her criteria for property is higher than theirs. That's why she's successful. So remember that. Know your market, and you have to set your standards, or at least your discussional standards. When you speak to them, you don't ask what their minimum standards are, or minimum requirements for net worth, liquidity, debt service coverage ratio, things like that. You have a dialogue. Talk about what they like, what they have an appetite for, what they're lending on most. Talk about the area and demonstrate that you know where the growth is. You know what the driving forces behind, you work with the EDC, you know the driving forces behind the area. Demonstrate your knowledge of the market. And then you can get into some specifics of what you like to see in a property and your debt service. But note, it's got to be better than theirs. It's got to be higher. That way they know they're working with a candidate that's going to make their life easier and is going to close deals. So keep that in mind. Don't ever ask what the minimum requirements are. Back to the transactions, I get off track often, so feel free to just knock me in line. The transactions that you're going to use bridge lending for, you folks are probably looking for discounted payoffs. You're looking for properties at auction. If you're working with Sue, you're turning every rock there is if she's showing you the tricks on where to find deals and how to get creative about coming up with them. Sometimes you just create your own. You didn't even know they were there. When that happens, there is value in being able to get to the table quickly, one. Or there is value in being able to close with limited documentation. These are the types of scenarios where you would come in with a bridge loan when you need to get to the table quickly. You're going to realize a lower price point, and you're going to make your money when you buy it. Like anything else, if there's any car dealers in here, bike dealers, you make your money when you buy the property. So this allows you to go in and do that. Also, if your exit strategy is short term, let's say you're just going to buy it because the way the market cycles is and you want to get in and get out quicker than usual, a bridge loan is a viable option for you.